McDonald's just reported a solid quarter. Earnings beat expectations. Global comparable sales were positive in every major segment, and system-wide sales were over $34 billion. But the stock is still down near its 52-week low. And that creates the real question. Is McDonald's finally a high-quality dividend compounder at a fair price, or is the market warning us that slower consumer spending and a premium valuation still matter? This is not financial advice. I'm walking through the business, the latest quarter, valuation, bull case, bear case, and what I would watch next so you can decide whether McDonald's belongs on your own research list. If you like stock breakdowns that separate great businesses from stocks that are still not cheap enough, subscribe to FinanceToGo. The goal here is simple: numbers, valuation, and plain English stock analysis. No hype. So, why do investors care? McDonald's is one of the easiest businesses to understand. It has a global brand, a massive franchise system, rent, and royalty streams, a long dividend history, and the kind of convenience that makes it part of everyday life for millions of customers. That is why the stock usually gets a premium valuation. Investors are not just paying for burgers and fries, they are paying for a global cash flow machine. But when a mature company trades at a premium, the numbers still have to support the price. So, let's have a look at the latest quarter. The Q1 numbers were good. Revenue was $6.52 billion, up 9% reported, and adjusted EPS was 2.83 versus about 2.74 expected. Global comparable sales grew 3.8% with the US international operated markets and international developmental licensed markets all positive. The strongest part is that this was not just one segment carrying the whole result. US comparable sales were up 3.9%, international operated markets were up 3.9% as well, and the developmental licensed markets were up 3.4%. Loyalty also stayed important, with over $9 billion of system-wide sales to loyalty members during the quarter. The watch item is quality of growth. McDonald's is leaning hard into value, marketing, and menu innovation. That can defend sales, but I still want to know whether traffic is truly improving or whether the company is relying too much on pricing and promotions. So my FinanceToGo score is 7.7 out of 10. Profitability and cash flow score is high because the franchise model is excellent. McDonald's can generate a lot of cash without needing to own every restaurant directly. The score is not higher because growth is mature, debt is meaningful, and valuation is not a screaming bargain. This is a quality business, but a quality business at the wrong price can still give investors average returns. Let's take a look at the valuation range. So at around $274, McDonald's sits inside my rough fair value range of $255 to $295. That means I do not see it as a wildly expensive after the reset, but I also do not see a huge margin of safety just yet. The buy zone is cleaner below roughly $240 to $250. That range gives more room for slower traffic, higher costs, debt, and the fact that this is a mature company. My base case is simple. McDonald's is probably fair around here, but fair value is different from a high conviction bargain. The bull case starts with the brand and the business model. McDonald's has global scale, everyday customer relevance, and a franchise system that can produce margins and a durable cash flow. The second pillar is the quarter itself. Sales were positive across every major segment. Adjusted EPS beat expectations, system-wide sales were over 34 billion, and loyalty is still a major asset. That tells us the business is not broken. The third pillar is shareholder returns. McDonald's has a long dividend history, consistent cash flow, and the ability to return capital over time. If value meals defend traffic, restaurant growth continues, and margins hold up, the current stock weakness may end up looking like a reasonable entry point into a world-class compounder. So the compressed bull thesis is this: elite brand, franchise economics, positive comps, strong cash flow, loyalty scale, and dividend support. If traffic proves durable, McDonald's can still be a quality compounder worth owning at the right price. The bear case starts with the valuation. McDonald's is not priced like a broken company. Even after the reset, investors are still paying a premium for reliability. If earnings growth stays modest, that premium can limit future returns. The second risk is the consumer. Value meals can help protect sales, but they do not automatically prove customers are visiting more often. If lower income consumers stay pressured, sales growth could depend too much on price, mix, or promotions. The third risk is leverage and margins. McDonald's can support a lot of debt because the business is durable, but roughly 40 billion of long-term debt is still something to watch. If margins weaken while debt and shareholder returns stay high, the stock becomes less clean. So the compressed bear thesis is this: premium valuation, mature growth, consumer pressure, promotion risk, and high debt. For me, the thesis weakens if comparable sales turn negative, traffic keeps slipping, operating margin weakens, or free cash flow no longer comfortably supports dividends and buybacks. My verdict on McDonald's is watchlist. World-class business, not a bargain price. The business is strong, the brand is strong, the quarter was good, but at around $274, I would rather see either stronger traffic proof or a lower price before calling the risk-reward clearly attractive. The investing lesson here is simple: a great company can still be just a fair stock if the price already assumes quality. For McDonald's, the next scoreboard is comparable sales, traffic, operating margin, free cash flow, debt, and dividend coverage. If you do want more stock breakdowns like this, subscribe to FinanceToGo and tell me in the comments, would you pay a premium for McDonald's quality or would you wait for a better buy zone? Again, this is educational content only and not financial advice. Do your own research and make sure any stock fits your own risk tolerance and time horizon.